Today, an ace in the hole, the DFA daily to the 26th of August 2021. Hello again, it's Martin North from Digital Finance Analytics, working on this post covering finance and problem news with a distinctively Australian flavour. In today's show, we look at the fallout from the government's stimulus for the housing sector, consider the likely outcomes from Jackson Hole, and what the markets are expecting, questions about momentum in China, and we'll also consider whether the markets still have legs in the weeks ahead. Now, amid the turmoil, it's worth reflecting on the massive stimulus governments across the country gave our housing sector. As Tim Toohey of Yarra Capital pointed out, the take-up rate for the federal government's home builder scheme was more than 4 times higher than expected. The government received more than 99,000 applications to build a new home via the scheme, as well as some 22,000 applications to undertake renovations on an existing home. Toohey adds that there is also a good chance that house prices will fall over in the next couple of years. Taxpayers have effectively handed out almost $3 billion of free money to people to build or renovate their home, Toohey said. But there are consequences, given the current slow population growth. He says that together with state-based incentives, this will result in an oversupply of new housing by 2023. Historic building approval levels for standalone homes, matched with unprecedented falls in population growth, largely due to closed borders, will create the biggest overbuilding of new houses since 2008. Going into COVID-19, we had a little bit of a shortage, but that will turn into significant oversupply, he concluded. The penny hasn't dropped, but when it does, it will take the heat out of house prices. But to me, the question is this: will the government do yet another round of more stimulus? If so, then price falls may just not happen, at least for some time. But again, it underscores the fact our property market is one big government-backed Ponzi scheme. No free market here. And this, by the way, is a microcosm of the bigger picture. On Friday in the US, the virtual Jackson Hole Economic Policy Symposium will take place. Many market watchers are holding their breath for some great sign from the Fed about future tapering of the $120 billion of stimulus programs. As Goldman put it, the theme of the conference is macroeconomic policy in an uneven economy. Chairman Powell will give a speech on the economic outlook at 10 a.m. EST on Friday, which will be broadcast online. They say, "We think the FOMC's intention is to formally announce the start of tapering at the November FOMC meeting, if all goes well by then, and to taper at a pace of $15 billion per meeting." So we see a 45% chance that the formal announcement will come in November, a 35% chance it will come in December, and a 20% chance it will be delayed until 2022. We put high odds on delay beyond November because of the downside risk posed by the Delta variant. And they said, "We expect Chairman Powell to acknowledge both the strong employment gains in recent months and the downside risks posed by the Delta variant. That would keep expectations on track for a potential September warning and November taper announcement, but would carefully avoid locking the FOMC into that timeline." Now, I'm sure we're going to get some mention of inflation easing back from recent highs thanks to temporary supply issues, references to the wobbly labour market, and signs that Delta is denting recovery. All this means that even if the Fed were to taper later in the year, the macro picture suggests a greater likelihood of more QE next year. And that being the case, we might expect a small market pullback before it heads higher yet again. There is, in my view, actually no way back. The QE programs have effectively become infinite and enduring, and the main reason is to keep the costs of government borrowing contained and to protect bank profits. So it will be interesting to see how explicit the tapering is in the statements, yet alone quantitative tightening reference. That said, the S&P 500 and Nasdaq closed at record highs on Wednesday for the second straight day as financials and energy climbed ahead of the Jackson Hole Symposium. The S&P 500 rose 0.2%, to close at a record 4,496, and the Dow Jones Industrial Average rose 0.1%, and the Nasdaq climbed 0.2% to close at 15,041. The tentative move higher in the broader market was led by financials, mostly banking stocks, as Treasury yields continued to make up ground, with the 10-year yield rising above 1.3% following a dip last week. The banks were stronger as high interest rates boost the return on interest that banks earn from their loan products. Energy turned positive, adding to recent gains after oil prices rebounded on data that showed that weekly US crude supplies fell more than expected. Crude inventories fell 2.979 million barrels last week, compared with analyst expectations of a draw of 2.683 million barrels. Crude oil for delivery in October rose 0.86% to 68.12. The volatility index was down 2.5% to 1679. Gold futures for December delivery were down 0.89% to 1,792, and the Euro-US dollar was up 0.17% to 1.1773, while the US dollar's index was down 0.06% to 92.84. In terms of our own economic recovery post-COVID, there are a couple of factors to watch. First is the iron ore price. Bloomberg said that iron ore surged on expectations of a recovery in economic growth, including additional support from the Chinese government that will boost demand for steel. Futures in Singapore rebounded as much as 10% as a potential boost to the US vaccination drive lifted sentiment across assets from stocks to base metals. And separately, China's central bank chief vowed to stabilise the supply of credit and boost the amount of money supporting smaller businesses and the real economy after both credit and economic growth slowed in July. In China, people are hoping for some further stimulus targeting the infrastructure sector, as real estate and manufacturing are looking bleak, said Eric Hedberg, principal analyst at CRU Group. In the rest of the world, we are seeing steel production stabilising at levels below pre-pandemic levels. Iron ore has had a spectacular collapse, losing about a quarter of its value in the past month as China's push to reduce steel production hammered demand. Iron ore stockpiles in the country's major ports expanded 1.3% last week, signalling a softening in consumption, while steel output fell in July. Market watchers have pointed to more volatility to come amid a complex policy backflip in China, as well as uneven economic recoveries. And then there are those Chinese students which used to support our education sector here in Australia. Now, all of this was foreshadowed back in 2019 when Salvador Babones, the chief student boom and the risks it poses to Australian universities paper came out. I interviewed him at the time. This showed that Australian universities had become dangerously dependent on Chinese students, with concentrations that dwarf similar advanced nations. Around 1 in 9 students at Australian universities in 2017 were Chinese. And in addition, the Business Council and Asia Society warned that the excessive concentration of Chinese students at Australia's universities had stifled free speech and debate, as well as compromising academic integrity. Far from serving to diversify the student cohort, the dependence on Chinese students has instituted a form of classroom monoculturalism, in which encouraging students to embrace the value of academic integrity and free debate and facilitating the development of core capabilities in critical thinking, effective English communication and cross-cultural competence has become increasingly difficult, they said. The report recommended that universities tighten academic and English language standards for Chinese students, requiring higher scores in the Chinese end-of-school exam, the Jiaokao, and put more emphasis on the International Baccalaureate as an entry examination. And now we know that no Australian university has been approved to establish such a course with a Chinese university since 2019, although universities in other countries, including the US, Britain, Canada, France, Germany, and even New Zealand, have been given the go-ahead to set up joint programs. The courses in which Chinese students do the first 1 or 2 years at a local university and then transfer overseas to complete the degree are very popular and used by universities in many countries to build their student market in China. Before COVID-19, more than 100 such courses called twinning programs were run by Australian universities in China, with over 13,000 students enrolled. And while we're on China, the SEC has modified the disclosures needed for Chinese IPOs, in part because of Beijing's recent actions. Look at the performance of the Nasdaq Golden Dragon Index, which is comprised of companies whose shares are traded in the US while conducting a majority of their business in China. It set a record high in mid-February, a few months after Beijing stopped the anti-IPO. It was halved in the following 6 months and recorded its lowest level since June 2020 on August the 19th. The index has fallen for 8 consecutive weeks, coming into this week, and 11 of the past 12 weeks. The Golden Dragon Index rose by 8% yesterday. It was the third successive gain. The fear of missing out may be greater than the fear of Beijing's moves. US SEC Chair Gensler renewed his warning that unless Chinese companies listed in the US allowed inspections of their financial audits, their shares could be delisted from the New York Stock Exchange and Nasdaq starting in 2024. And again, according to Nomura, Beijing's unprecedented determination to curb the property sector could be China's Volcker moment, as it will cause a significant slowdown in economic growth. Central to this project is the reining in of runaway capital misallocations like the property sector. Empty apartments do not add to production and create an enormous debt hangover that sucks income dry over the long run. We've seen China time and again try to achieve this. In 2015, it crashed property prices and sent iron ore to $38 before finally panicking with more stimulus. And now it's trying again with the 3 red lines policy that directs property developers to deleverage. That has led Nomura to conclude that this time China may be serious. Unlike in previous economic down cycles, Chinese authorities look set to tighten property sector policy and tame prices this time in order to reduce wealth inequality and boost the falling birth rate, economists led by Liu Ting wrote in a report on Tuesday. Policymakers will be willing to sacrifice near-term economic growth to tame house prices and divert financial resources out of the property sector, which accounts for a quarter of China's gross domestic product, they wrote. A Volcker moment refers to a policy change like the decision by the Federal Reserve under former Chairman Paul Volcker to quickly raise interest rates to 20% to contain the inflation of the late 1970s. That sudden change caused a jump in unemployment, but also led to inflation slowing. Markets over the near term need to be prepared for a likely marked growth slowdown, more developer defaults and home foreclosures, and perhaps some turmoil in stock markets, The Economist wrote. Authorities appear to be determined to expand the property tax scheme from trials in Shanghai and Chongqing cities to the entire nation. According to the report, this will address wealth inequality and help replace local government's income from land sales, which will be reduced by the ongoing curbs, the report said. And so, in both the US and China, both economies which dominate the planet, frankly, it will come down to whether authorities will really have the mettle to turn growth down and remove stimulus, or whether they will panic or be forced by the markets to continue to stimulate. I have to say, despite the words, it will be down to the real actions taken. Either way, our own economic future is not actually in our own hands, but rather in the hands of policymakers and bankers in countries far, far away. And I might add, in terms of what's ahead, there's also been a lot of rubbish being spoken about winning our freedoms at a specific vaccination rate. But all the real evidence suggests that there is no simple path forward, even at rates above 90%. Another reason to be pretty cautious at the moment. And yet, there are arguments as to why stock markets may still have legs. As Market Watch put it, there are plenty of absurd arguments that investors make to justify their position, but one that is particularly maddening to me is the notion that the stock market can never be ready for a correction. Not only is there an abundance of research that proves the folly of market timing to avoid downturns, but such statements seem to indicate you can easily predict market moves in general, and all you have to do is to identify the forecast, and you can ensure you're early rather than late to a trend. As we know, particularly after the remarkable COVID-19 disruption and an equally remarkable snapback rally, there are never any certainties on Wall Street. So before you stick a fork in the current rally and write it off as overdone, there are plenty of reasons to stay fully invested and to expect the current rally for stocks to keep rolling through to the year end. There's already strong momentum in stock. For example, the S&P 500 has just notched its fastest doubling in history as it surged from lows of around 2,240 in March 23rd to around 4,500 in August, and it also has already set 50 closing records this year. This kind of record-breaking momentum clearly can't last forever, but it's important not to conflate this strong performance with the assumption a correction is overdue. Generally speaking, stocks tend to move higher simply because they're moving higher, not suddenly crash out of the blue. And then earnings are still pretty impressive. Companies across the S&P 500 have beat estimates by an average of more than 90% in the last 5 quarters. That has fueled a lot of gains that we've seen in stocks. For example, Nvidia was up 1.93% and has just popped up 14% in a week on a strong earnings beat. Or sports retailer Dick's Sporting Goods surged above 20% in a single session after a strong report this week. Sentiment and technical indicators aside, it's hard to argue that there's no true improvement in fundamentals behind this recent run for stocks. And then there's also the question of Fed tapering. Maybe those fears are abating. One of the bearish arguments some investors have had in 2021 is that the US Federal Reserve is considering tapering stimulus efforts that includes the $120 billion in monthly bond purchases by the central bank, among other things. However, most reports indicate any such stimulus drawdown will not occur in the near term, perhaps not even until November at the earliest. That may sound like bad news for those who are more hawkish on monetary policy, but it is undeniably good news for near-term market dynamics. And then Wall Street remains bullish. According to recent data, 56% of analyst recommendations on S&P 500 stocks are buy or equivalent. That's the most since 2002, and a sign that there is continued upside for the stock market even after an already impressive run. There's no guarantee that the so-called smart money is correct, of course, but it's an important indicator nevertheless. And then there's the housing market wealth effect, because generally speaking, the typical American doesn't have the majority of its wealth tied up in stocks. Rather, their home represents as much as 2/3 of their total assets. And as a result, their general perceptions of the economy and the investing environment tend to be coloured by real estate more than anything else. That's particularly good news in 2021, as housing prices continue to surge. In July, median house prices were up by an impressive 18.4% over the prior year. That wealth effect can go a long way towards supporting spending and investment sentiment in the months ahead. And then we need to look at core inflation versus inflation for food and energy. It's important to acknowledge that the chatter about inflation risks in 2021 don't often include the full story. In July, the year-on-year inflation rate in the US remains a 20-year high of 5.4%. But when you skip food and energy prices, which are historically quite volatile, the core monthly rate of inflation was, well, just 0.3% in July, which isn't just modest, but below expectations of a 0.4% gain. And bigger picture, inflation doesn't equal a bear market anyway. It's also worth pointing out there is little direct correlation between relatively high inflation and relatively low rates of returns for US stocks. Take 2011, when headline inflation threatened to hit a 4% rate, again driven largely by food and energy, and some investors fear that that would upend the recovery from the 2008-2009 financial crisis. Now, there was certainly volatility that year, but stocks hung tough. The S&P 500 moved a few percentage points higher on the year, then gained nearly 15% in 2012, the following year. And what's the alternative now is the question. Despite inflationary talk, hard assets like gold haven't been the great bet for investors looking to grow their nest egg. The most physical gold-backed fund out there is actually in the red over the past 12 months and down about 5% from its May peak. Unless you think the bond market is safe, major bond funds are actually down 10% over the last year, even as yields have rolled back from their spring highs. Gold or bonds may be nice hedges or insurance policies, but where else other than stocks can investors actually access growth on Wall Street right now? Most investors should ignore short-term trends anyhow, because all of the above is based on the most recent headlines and trends. But for most investors, it pays to ignore those trends and stick with long-term plans. According to Goldman Sachs research, stock market returns have averaged 9.2% over the past 140 years. Sure, there are always a few bad years along the way, but if you stay invested long enough, you'll almost certainly come out significantly ahead. Keep that in mind before you try to time the next potential bear market because of short-term volatility fears. And that really is the point. It is very hard to navigate your way around this. My own perspective has always been long-term investment makes a lot of sense. But nevertheless, we are also in very uncertain times, and those quantitative easing programs which are continuing is also distorting the market. But if you believe, as I'm coming close to believing too, that it's unlikely we're going to see quantitative easing going away anytime soon, then certainly there is still potential upside for stock markets. On the other hand, the bubbly pressure is very strong, and at some point it probably will pop. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.